You've been saving the taxes while you're earning. But what happens when you retire and you have to start taking money from those retirement accounts? Hello, welcome back to Making Money Manageable with Alan Dembski and Juliana Janson from Buffalo First Wealth Management. Today, our topic is one of the most popular questions that we get is centering around Roth conversions. Should I or should I not? We're going to give you 4 Roth conversion traps and how to avoid them. And hopefully you enjoy this video. We're just wrapping up tax season and we are doing a lot of planning for Roth conversions. So if you don't have a financial advisor and need some guidance around Roth conversions, you can certainly send us a message via our social media channels. We'd be happy to answer those for you. But, one of the questions we talk to clients about first is, does it make sense for your specific situation? How much Roth assets you have, how much pre-tax assets you have, does it make sense? And one of the bigger questions is, and we discuss this all the time with clients, is, yeah, you've been saving all your life in pre-tax, which is great. You've been saving the taxes while you're earning. But what happens when you retire and you have to start taking money from those retirement accounts? A lot of people just assume that they're going to be in a lower tax bracket. That's not always the case when you retire and you have RMDs that you have to take. Maybe you have
required minimum distributions.
Yeah, sorry for investment lingo. I'll try to stop that. Whether it's that pension income or any other sources of income that you might have, you might not be in a lower tax bracket later on. The other thing is, what are the balances of those traditional IRAs to help determine that? You can use many calculators online to kind of give yourself an idea of what your RMD is going to be, required minimum distribution, and how does that fit into your financial plan going forward. So those are some things you got to look at before even considering whether the Roth conversion is right for you.
Another reason to consider to convert is that your heirs might be in a high tax bracket. So maybe mom and dad are doing well, but they're not crushing it, but their kids are crushing it. That would be a reason to convert at mom and dad's lower tax rate rather than pass that IRA asset on to their kids, where they have to realize that income during some of their sometimes peak earning years.
Stay tuned for our next video on inherited IRAs and Roths then.
Yes. So one of the traps to consider that people don't always think about is sometimes a down market might be a good time to convert. So let's say you're converting $100,000 in stocks from a traditional IRA to a Roth. If the market goes down, that actually might be a good time to do your conversion because you'll be paying taxes on it at a lower rate at the time of conversion. Then hopefully you're going to convert it and it's going to be in a Roth, and then it's going to appreciate tax-free after the conversion is done. So nobody really likes a down market, but that can be an opportunity for you to do your conversions when the market is down, which we usually have every year.
And just make sure your custodian will transfer the shares from a traditional to a Roth.
Or if not, or if you're converting cash, then just invest it into the equities after you do the conversion, as long as you're not running afoul of the wash sale rule.
That's right. Another thing is that another trap that people sometimes overlook is, where should I pay the taxes? Should I withhold taxes from my IRA and then convert the balance to my Roth? We think our suggestion is making sure that you have enough assets outside of retirement accounts to pay the tax bill on that conversion and not reducing that conversion with the tax withheld from that account.
Yeah, and everybody's situation is different. It still could make sense to do the conversion depending on your whole plan, even if you have to take the assets from your pre-tax traditional accounts. But it's preferable, if possible, definitely to take it from your brokerage account or another.
The numbers shake out better.
They absolutely do.
Look a lot better when you're doing your planning if you pay taxes from another source.
Yeah. And the other considerations are, what other types of taxes might that Roth conversion be triggering? So for instance, Social Security, above certain income levels, you pay different levels of Social Security tax. You kind of want to take that into account. The numbers are pretty low, so most people find themselves taxed at the 85% level anyway,
Right.
particularly ones that are, considering converting large amounts of Roth. But it's definitely something to consider. The other consideration that people hate and a lot of people talk about is the IRMAA, income related monthly adjustment amount surcharges. And those can be quite hefty depending on what your income level is, particularly if you're planning on doing a large Roth conversion all at once. That's where it might make sense to spread out your Roth conversions over multiple years so that you're not triggering those higher income levels, which will trigger your IRMAA surcharge. My mom had a best friend named IRMAA, but this IRMAA is not your friend.
And the IRMAA is on your Medicare tax, or your Medicare premium. So that's for a whole year that you're paying that IRMAA surcharge for your Medicare throughout the whole entire year. So it's not
That's
just a
good.
one-time penalty or fee; it's through the whole year of your Medicare.
That's a good point. And the other surtax that people don't always think about is the net investment tax. This is a tax on investment income that is paid by higher income taxpayers. So it's just definitely something you want to talk to your tax preparer about before you actually pull the trigger on the Roth conversions.
And the fourth and final thing that we want to talk about, or caveat to a Roth conversion, is tripping over the 5-year rule. Roth IRAs have strict rules regarding when you can distribute money tax and penalty free. So depending on your age, when you open the account is going to set off this 5-year rule. So if you're under 59 and a half, every Roth conversion is going to start to clock for a new 5 years of holding that account. So if you're over 59 and a half, if you open a Roth or do the conversion, you have to have that account open for 5 years before you got some penalty, or tax-free, not penalty-free if you're over 59, some tax-free assets. And the whole purpose of the Roth is to have 100% of it tax-free. So looking at when you're going to distribute money from that account is really the key to all this anyways. If you don't plan on distributing any money from Roth for 10, 15, 20 years, it's kind of a moot point, right? So you kind of got to look at what you have in reserves, making sure that you have an emergency account so you don't have to dip into any newly converted money when you need cash flow to help with future cash flow expenses. So if you have any comments or want to add to the conversation, feel welcome, and also like and share for more.